The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, this is Chris. It's June the 6th, 2017, and welcome to summer everyone. Hope you had a good Memorial Day weekend, and I'm going to go ahead and get started. Want to talk about several things today. First thing is to try to get my clicker to go for me. I apologize for that. Here we go. As we start off each monthly webinar with just a reminder that being bullish or bearish to me is a psychological state of mind, and we're not. We're about strategies. We're about the power of the pattern. We're about trying to provide solutions and not trying to take a lot of your time providing those solutions to you. As a reminder, we want to be your 28-second advantage, that you can see some ideas, our read on the power of the pattern, and what action that we feel should be taken, and we don't try to consume a lot of your time with beliefs, rhetorics, and fundamentals and different things like that. So as you know, we're all about power of the pattern, so we're going to get started. But wanted to kind of remind you what we'll talk about today. We've got a nice buffet line, or I hope it is, that it whets your appetite. We're going to talk about stock indices here and abroad, or it's the States and abroad. Also a couple of charts on the reflation theme. We're going to look at interest rates and bonds, some interesting action taking place there. We're going to discuss some valuations and sentiment. Then we'll move on to some metals, which we're going to save, I think, some of the best for last. I think some really exciting things to be taking place there. A real quick look at crude oil, and then we'll just finish up with each of our positions individually. So as a reminder from a 30,000-foot view, the chart on the left is the Dow monthly, and we just took the monthly high in 2007 and 2009 and applied Fibonacci to it, and you can see that it ran up to this 161 level for the Dow, was about 18,200, played around there and backed and filled, and then once it broke above it, it came back, which is fairly ideal to test old resistance as new support, and it took off. Similar thing was done on the S&P, and as you know, we're starting off the global dashboards with this as a reminder from this is a 10 to 12 year look at the Dow and S&P, so to kind of always create that big picture perspective. But you can see the S&P did similar things as far as it bounced up against the 160 level for over a year, and then broke above it, came back down and tested it as support, and actually penetrated a little bit, and then this was right before the election, and then it blasted off. So from a 30,000-foot view, these charts still look healthy, and from a really long-term perspective, the 261 level on the Dow is essentially 25,000, and on the S&P is 3,000. So those are just some round numbers. I mean, they came out this way. Obviously, it's 3,032 on the S&P, but when we're looking at such long-term time frames, I think that's just the zone of 25,000 and 3,000 that sometime could be reached, downstream. But we got a long way to go before that takes place. But just to lift up the hood and look underneath, this is the advanced decline line on the New York Stock Exchange, and this is common stock only, so this is stripping out ETF and any government bonds. So you can see that just a really nice clean channel remains in place since 2009. The index is in the upper right, is within 1% of all-time highs, so it's acting healthy, sending a positive message. What we would look for here is any type of divergence. In other words, if we started seeing lower highs while the market was still hanging up there, that would be a negative divergence. None of that's taking place at this time. To raise any concerns, you'd need to see, in my opinion, just as a small starting point, you'd have to see the advanced decline line kind of break below the shelf, which is not taking place. So at this time, historically, when you see pullbacks in the market with this healthy of an advanced decline line, they're often shallow, and they don't last too long. Right now, still a bullish signal continues to come from the advanced decline lines from a 30,000-foot view. Junk bonds, similar vein. You can see over the long run, I'd still say that the junk is diverging. This is J and K, because as the S&P is at all-time highs, you can see that J and K is not above 2014. I'm not losing any sleep over it, but it is a fact that it's not near its highs. The lows in 2016, you can see in junk, took place. To be bullish on this market, you prefer to see junk moving up. I kind of look at this as the generals that are leading things up a hill typically are, you know, your big caps, and when you look at junk, they're essentially the troops, and you don't want to be the generals and be on the top of the hill and look back and you see that the troops aren't coming along with you. You probably got a problem. So no negative messages at all at this time coming from junk. Same thing, we would want to look for negative divergences if that was taking place, and it's not. You can see a narrowing pennant pattern or a potential bullish ascending triangle is taking place, you know, right in this zone. We saw this is a weekly, weekly chart, and we saw that last week it was down a little. So continuing bullish messages coming from here. Would get concerned about junk if for some reason it started selling off and broke below this support that took place essentially from January of 2016. So bullish message, concerning message would come if that one, almost a year and a half, not quite, support line would break at 2. This is a global six-pack. So just got to go through these real quickly, and just to give you a little clues, you can look at this, you know, back on your own, stop and start. If you got insomnia and you just want to keep hearing this over and over, which it's not going to happen. But the S&P up here, or what the index is in the gray. So this is the S&P in the upper left. Dow in the middle, and NASDAQ here. Have the Russell, mid caps in the middle, value line geometric, and then we have Germany in the left, France, and London. So going back to the top, very clean from a big picture perspective. Rising channels continue to take place in the S&P, the Dow, and the NASDAQ. The green lines were the top of the Fibonacci resistance of the 2015 highs. So you see all three of these have broken cleanly above that. Going to the middle, small caps have less to brag about. They still are. They're not at all-time highs. They're very close to it. But if there was any lagging indice, if we wanted to look down that road, it would be small caps, and they are attempting to break out. We'll look at it a little later of a potentially bullish ascending triangle. Mid caps, there continues to be in small and mid just some choppiness the last few months. They're not leading the market. They're not falling apart either. Just continued sideways. This could be viewed as a base that's being built for higher prices in an ongoing rising market. We're going to look at Germany in just the following page, but just to look, Germany, this blue line is a 2015 high. You can see that's barely above it. We'll zoom in there. And France and London are acting healthy. They're both testing long-term rising channel breakout levels. So as I just said, we'd look at Germany a little bit closer. Germany peaked in 2015 inside of its multi-year rising channel, and then backed off. And it backed off, no surprise, to the bottom of the channel. Then it's pushed higher. A positive of late, I would say here, is that it broke above it. It didn't quite come back to test, really close, within, I suspect, less than 2%, that it came back down to almost test the old resistance as support, and it's pushed a little higher. So the support line that's key is the 12,400 zone. You can see on the right side of the chart that it's trading around 12,700. So that's a couple of percent below current prices. So positive action taking place. If the dollar would remain weak and the indices in Europe would come back like they have and test old support, it almost would look like one of the charts that we looked at on the S&P. We started off this whole webinar, you know, that it broke, the S&P broke above resistance, came down and tested as support. We see continued strength here and weakness of the dollar. There's a good chance that EWG, which would be the German ETF, you know, the DAX index itself, and a couple other foreign ETFs would do, you know, really well. And so this is a big key, I believe, for future positions in the European markets, but also just what takes place in the States, because if this would fail to be a breakout and then roll back below the 12.4 level and start showing weakness, I'd be very surprised if that weakness didn't come back to the States. So London, you see it's doing well. It's trying to push above, as I just mentioned a little bit ago, a couple of slides, that it's trying to break above rising channel resistance, which is still positive price action. Again, due to dollar weakness and the stock, I guess we shouldn't say due to dollar weakness, but these stock markets in Europe are acting stronger, than many markets in the States outside of some narrow tech indices. So a good price action. I don't have a support line here, but right in this area, it's trading out 7,500. If London would break back below this channel, that would send a concerning message, but right now, continuing bullish message coming out of London. This looks at the S&P in the upper left, the bank index, which is the BKX in the upper right. The lower left is the Russell, and the transports are in the lower right. So all are in uptrends, but you can see 3 of the 4. The S&P is real close, if not right at all-time highs. But you can see that banks have been, it's hard to tell here, we will dig into this in a couple of charts, but banks have been weak since the last few months, and there's a potential topping pattern here that has my attention. Not proven because the trend remains up. You can see a lot of choppiness in the Russell. This top line here in the bottom, if we would zoom out, you'd see is like a 20-year rising channel. So this is a key breakout level where it's pretty much chopped sideways for several months. And here's the transports index that continues to see some overhead resistance right above. We've addressed that this could be a possible head and shoulders top. Ideally, if the right shoulder was to take place, it would have taken place right in here a couple of weeks ago, but we have seen some rally strength. So the trend remains up, choppy for the last 6 months in transports. Obviously, it would send a very bullish message if it could break out, and then it would send a very concerning message if it would break down in case this was almost a 8-month head and shoulders top. So we're going to continue to watch. I highlight this is what I kind of call the weak 4-pack. The S&P in the upper left is not weak, but these other 3 are weak relative to the S&P. So I'm just kind of watching them really close. This is the bank ratio. So this would be the BKX divided by SPY. And we'd picked up banks last summer. We'll look at that in a later slide back in August. So almost a year ago, we picked up banks. But this is banks relative to the S&P. You can see that they really took off. It was one of the best places to be on the planet was in the U.S. banks, particularly from the time of the election through around December the 1st. It was a really quick pop up. What that did lead is this sharp rally. You can see the momentum indicator, that the momentum indicator was the most overbought here at the top or lofty of any time in the last quarter century. And at that same time, a couple of resistance lines were coming into play. We've continued to highlight this chart now for 6, 7, 8 months, and it's continuing to reflect that banks are weaker than the broad market. Broad market hasn't, this weakness in banks hasn't stopped it, but traditionally you'd like to see an equality S&P 500 rally. You'd like to see at worst the line flat, which would mean that the banks are keeping up with it. An ideal point would like to see it to be stronger or heading up, but we're seeing this tail off, and some weaknesses continuing still in the bank sector and relative to the S&P. Why this has my attention, this is the bank index, again going back 15 years, decade and a half, and it's just that this possibility that there's 2 channel resistance lines. We were a buyer back in here last summer, and we'll look at that later, but we just sold into this, still own 10% of that initial position in case I'm wrong on this head and shoulders top. But as this dual resistance was coming into play, just sold into this strength, and since we toned it down to just a 10% position, there's been a few times that the remaining shares have been up as maybe as high as 21, 22, and then now we're standing at 16. So you can see that position is backed off, and then I have a stop we'll look at later just below, in case this is a head and shoulders top, just below what this potential neckline where that could be. So as a reminder, we talked about the Fibonacci levels from a really big picture. This is a little narrower, but we continue to share this in the global dashboards where we took the lows and highs, the closing high right here in 2016 and applied Fibonacci, and you can see that the S&P ran up to it, backed off, so far as punched above, came back and tested old resistance as new support. So the left and right charts are the same charts. We just have closes on the left, candlesticks on the right, and you can see kind of the price action that took place up here. You can see that they tried to sell it off at what this was, this key level, which again was old resistance as new support, and then the market's pushed higher, and this is a weekly chart on the right. So continuing a healthy action still being reflected in the S&P at this key Fibonacci level. Now, moving on to what I want to call just kind of looking at the reflation theme or people's predictions. Back in March, shared in the sectors report the front cover of the Popular Delusions book that I felt like at that time that the headlines or a good number of people in the country were getting delusioned by this theme of the reflation theme. And this isn't pro or con or country or the Trump or any of that. It's just I believed it was a crowded trade, and so that's what I'm trying to here to help you with. So here's a kind of look at a couple of updates on what was, I thought, a really crowded trade. Two ratios, copper gold in the blue and the 10-year yield in red. And if the economy's to grow, typically the copper gold ratio rallies, and oftentimes if you have a growth scenario, as we all know, interest rates or yields increase, hard on bonds. But we went and shorted bonds last summer down in here and rode this rally in an inverse fund and sold into it. But I just kind of shaded in pink. You see both indices creating lower highs, which would reflect a lack of concern for reflation or growth. And then you can see this was almost a year ago where both of these took off in this green shaded area. So there's no doubt there was some feeling of the reflationary, but this is where I just thought it was just getting too popular up in here. So we can see now, since essentially the first of this year, we've continued to see a series of lower highs in both of these indicators. So it would reflect generally no or lack of inflationary concerns by the marketplace. And not that it's these are addressing the reflation theme or lack thereof, but they would typically suggest, or historically I would say, this is not an inflationary concern by the marketplace when you see these heading south. And you can see that the 10-year yield is now breaking. That was almost a double bottom. You can see that the 10-year yield now is pushing below support. And let's play a game of what if. You can see that yields came up to here and broke above some resistance last year, and they just blasted off to the upside. So we'll look later on in a chart, but what if the market was to fill this gap? That could be a pretty sizable drop, in yields, which could be an opportunity for bonds. We'll look at that in later charts, but from a reflationary perspective, not seeing much in either one of these indicators the last few months. Actually, 6 since this is June. This is another inflationary indicator. This is the two ETFs, the TIP, the inflationary ETF divided by TLT. You can see from 2011, you continue to see a series of lower highs, and this was last year where it took off and there was concerns of inflation. I still laugh that at this time the polls smelled and acted like this in July of last year. There was like a 0% chance the Fed was going to raise rates, and 90% of the investors were bullish. Now, with this rallying way back up, I believe that there's a 90% conviction now that rates are going higher. So at the same time that the crowd has shifted from 90% chance rates won't go up to 90% chance that it will, you're seeing this inflation indicator fall off, which historically, yes, the Fed can do whatever they want to do, but I don't care about what the Fed's doing. I want to look at, what's the 2-year note, the 5, the 10, the 20, and the 30, and inflationary indicators. And so this is the marketplace that we all trade, and you can see softness or lack of inflationary concerns taking place in this indicator. So let's look at interest rates, this interest rate 4-pack. So the top two are yields, 10-year yield on the left, 30-year yield on the right. They both remain in long-term falling channels. The 30 and the 10 hit falling resistance earlier this year, potential double top with momentum at one of the higher levels. You know, this inflationary, reflationary concern, this sharp rally in yields push these momentum indicators you can see on the 10 and the 30 very high. That's where we'll look at it later. We started taking positions and attempting to take positions in bonds. We've owned the bond fund AGG, I believe, now 6 months, and it was purchased when these yields were up here testing resistance. So the yields are starting to roll over on the 10 and the 30, and the momentum is doing the same. You can see despite some of the weakness in yields, momentum indicators are about mid-range right now, not oversold nor overbought. Now on the flip side, on the bottom is TLT and AGG. Own both of these at this time. You can see that they were both oversold and testing long-term resistance. AGG was purchased right down in here at the end of this past year. So momentum is rolling over from a yield basis, and prices momentum is turning up, and each of the ETFs, TLT and AGG, are making a small series of higher lows and a small series of higher highs. Positive for the bond market. Here's a quick look at TLT. It was purchased this past week as TLT was attempting a breakout. So the position's only been owned a week, nothing proven yet, but this is why it was purchased, a breakout above dual resistance. I didn't draw it in here, but there's somewhat the looks of a small ascending triangle, but positive we have a breakout. Here was this huge decline. That's just one weekly bar in TLT, which shows it was just really painful from roughly $130 down to what, 123. So $7 on 130 is what, ballpark is 5%. So that was really a huge decline that week. Very hard. We had shorted bonds right up here last July, just right after July the 4th, and they've fallen, and now we're trying to see if we can catch a ride to the higher side. And I'm not owning these bonds because of any macro or fundamental take. They're happening for whatever reason they're happening, and I like the price action. Here's just a real quick closer look at the 10-year yield, but as a reminder, this is a chart that goes back, what, almost a quarter century. There's a 25-year falling channel to where you can see that yields would kind of zigzag a little higher, then they'd hit a high, and then they'd fall apart for a while. And so dual resistance earlier this year appeared to be hit in yields, and you can see right up here, just zoomed in this price action. There's a potential double top, and that's where we started suggesting to go long bonds. As this pattern was taking place, resistance was being hit, and momentum was very high. When you look at where this stood here at the beginning of this year relative to the last quarter century, not many times has momentum been that high. As a reminder, the 30-year bond seasonality, a little busy chart, but let's kind of just walk through this. This is the purple is a year-to-date performance, but what I'm most interested in is, you'll notice at the bottom, there's a 5-year seasonality pattern, a 10 and a 20. Overall, you see, we're right here. You are here, the 1st of June, that each of these have drifted higher historically in the summer months, June, July, and August. Sorry about that. Got ahead of myself. But over the last 5 years, the drift has been not quite as sharp. As you notice, the 10 and 20-year average has been much sharper through the summer. I didn't buy bonds because of this seasonality. I bought bonds because of price, but I just kind of want to show that historically seasonality is decent through here. Here's a look at sentiment, which is kind of milquetoasty. It's just right in the middle of the road. You can see the extremes down here when we started looking, and we bought AGG when the sentiment was down here. right, again, we're pretty much in the middle of the road. You can see the extremes when we shorted bonds last summer. That's where the bullish sentiment was extremely high. So we went from a lot of bulls to very few bulls to mid-range. One of our good members sent or asked about the hedger's position in bonds. That right now is about the only concern that I have, is that historically bonds are closer to a high than a low in the positions that hedgers or the overall traders happen to own at this time. Not a screaming sentiment, extreme by any sense, but I just want to kind of update you that an overall bond optimism is about mid-range as we're looking at TLT and AGG pushing above old highs. This is the SPY ZROZ ratio. So this would be a stock bond ratio. Everybody knows SPY, but if you're not familiar, ZROZ is a long-term zero coupon government bond ETF, and one of the key words in there would be zero coupon, that it tends to have a higher standard deviation than TLT. So this is again would be a stock bond ratio. You can see that in 2014 it peaked here. In other words, stocks were outperforming bonds, and then from 2014 to right here, bonds actually did better than the S&P, or ZRZ did, excuse me. This is where we started shorting bonds, so then we've had this strong rally in the ratio, reflective of stocks are stronger than bonds. The rally went right back up to the highs in 2014. Nothing is proven here, but this is a potential, could be a topping pattern after a sharp rally up against key resistance. The key that I'd want to be watching for here, this is a rising neckline. Is that necessarily ideal? And the answer would be no. But whether this is a neckline, the bottom line is it is a rising support line that if it breaks would send a message that bonds are outperforming stocks, and I would suspect the couple of bond positions that we own would do well if that would happen to take place. So just a little reminder from Valuations and Sentiment. This is from good friend Doug Short at dshort.com. This is 4 different valuation indicators going back 117 years. You can see in the lower left 1900. The bottom line is, there's no holy grail of valuation tools, but just, as a perspective, here was the 4 indicators in 1929. They were about 100% above the regressionary mean over time. Here was 1966 when the market struggled for 15 years. Here was 2000. The bottom line is these are approaching not all-time highs, because this was obviously the highest in these valuations in the late 90s. But we are closer to historical highs than lows. That does not in and of itself right now. I love that phrase. It doesn't matter until it matters. I believe someday this is going to matter. Right now the price action would say people that are making it matter are actually missing opportunities. But in time I think this really will matter. But it doesn't mean a bull market has to stop here. But I believe it's essential for you to empower yourself that historically 10-year bull markets have not started from these valuation levels. Real quick look at the Buffett Indicator, which is the value of corporate equities to GDP, which is just a different one. This is a pretty good time snapshot going back from 1950. And you can see in the 60s when the market peaked where the valuation of the Buffett ratio was. Here was 2000. Here is 2007. So we're above 1965. We're below 2000. We're above 2007. And we're within, what, 20%, roughly, of the highest levels of all time. So again, this does not mean bearish by itself. Right now, it doesn't matter until it matters. But historically, this is not where long-term buy and hold bull markets start. We looked at this last month. I still think it's very important. This is the margin debt. And it's actually, most charts, everyone throw margin debt and the S&P on top of each other. What Doug did with this one was just to invert margin debt to show you extremes or large fish mouth patterns. But you can see when the two were spread wide apart, and the key is not the width that it is. I mean, it's important, but the signal to be concerned about the market is not when the fish mouth is wide open, is when it starts to close, or when margin debt starts to withdraw or decrease. If this line would rally, it would mean people are pulling margin debt off the table. They're getting less aggressive, and historically that's a cautionary signal. But you can see right now the fish mouth pattern is as wide as it's ever been in history, but margin debt is not turning up in the latest numbers. They come out once a month, to my knowledge. June should be out really any day, or it could be out today. We'll continue to update you with this, but as of last month, margin debt was not sending some concerning signal that it was narrowing. We shared this last month. This is what we want to call one of our new filters that we're going to continue to show you more. We have two more that are in the background, working, and we're having fun with. But this is just taking the margin debt and looking at when it crosses the zero line, and as far as we're looking for a retraction in margin debt. So in other words, when the margin debt, we just discussed it last slide, shrinks, it would be pushing this line down. And so when it crosses below the zero line, then that would be a concerning message, or in other words, one strategy for part of your money could be to take your S&P holdings and go to cash. So you can see there's been very few signals. This is going back over a couple of decades. Been very few signals to go to cash from the margin debt itself. But you can see that if you bought and held the S&P, it's the lower line, but if you had used the margin debt filter, you would have a few $100,000 more dollars, which is a pretty large percentage more. And the reason that the top line is bigger than the buy and hold, it's just these times when the line was able to go flat when the market fell. And the reason the line is flat is because that's when the margin debt indicator went below the zero line and suggested to be cautionary with your portfolio. So we've got this one and a couple more. We're going to continue to show you that we're excited for, for all members, what kind of opportunities, some of these new filters and fun tools that we're going to be sharing with you in the months to come. So to turn to metals, there's some, I think, some really interesting things going on here. This is one of the early charts every week in the metals report that premium members get each week, and this is the dollar gold ratio. So in other words, if you're bullish the metals, you want to see this falling because the US dollar is weaker than metals. But we've been sharing, since 2011, you've seen this continue to rise, which has been one of the more painful bear markets for the metals space in 25 years. But why I say this is a very interesting marketplace is this was the 2011 peak in metals. When this started heading up, that's when metals ran into trouble. And so for the first time since 2011, I didn't draw a top on this, but you can just kind of envision this has been a rising channel of higher lows and higher highs. And now potentially we have a series of lower highs and a break of support. So this would send a positive message to weakness here, would historically send a positive message to the metal space. So let's just look at the same thing, but let's just turn it over. If I think I can get my computer to work. So this is the same thing, but just the opposite. This is the gold dollar ratio. And so you can see in 2001 when I didn't draw it in here, but once it broke this long-term resistance line, it took off for 10 years, essentially from 2001 to 11. The ratio was moving higher. Gold, silver, and miners were screaming and far out, outpacing the S&P. Here was the 2011 high that took place in September. So if it's almost 6 full years that this ratio or metals have continued to soften. But you'll notice on the flip side, this has been a series of lower highs and lower lows, and now it's attempting to do something that it hasn't done in 6 years. This is a weekly chart, or monthly, excuse me. This is a very long-term monthly chart. It's attempting to break out for the first time in years from this falling resistance. So strength here in the gold dollar ratio is a very positive message for the metal space. So as we dig a little deeper, you all know that the Swiss franc is very important to me. The Swiss franc has essentially traded inside this blue box from about 97 to, let's just call it 107, 106, from a low to high. The franc is attempting to break above falling resistance here, which is a positive for the metals. What we'd want to see, as I mentioned down below, would be a breakout of the top of this trading range at the 106 level, which is roughly 2% higher. If the franc can do that, that's enough, and the gold-dollar ratio continues to break out of a 6-year falling resistance, these are really positive signs, or signs of things that metals bulls haven't seen in a long time. I'm not trying to get anybody's hopes up. I'm not a bull or a bear. I'm just trying to provide solutions and trading opportunities. I'm not trying to say what the message behind strong metals or weak metals are. That's just above our pay grade. But from a positive perspective, there's a chance that this is maybe a double bottom, a good basis being built for the franc to go higher based upon US dollar weakness. We'll get a few more of these signs, and it could be, for a lot of people, it could be back the truck up, towards the metal space. So that's the kind of potential that could be here. And speaking of King Dollar, this is a 25-year, roughly quarter-century chart on a weekly basis of the U.S. dollar. We continue to update this, but the dollar late this past year at 1 hit the top of a 7-8 year rising channel. This top line has been seemingly influential to the dollar since the mid-90s. Double bottom here. It came down here and broke that and came back above it, and it faked people out, and then now it really continued its downtrend from 2004 for 3 more years as it fell, kissed the underside of it, maybe head and shoulders top, and then it fell, and then now it's continued to make a series of higher lows for 9 years, since 2008. So this line we've been highlighting it for months and months. It felt like it was important. The dollar broke below a couple of Fibonacci levels, and this 3-year, 4-year rising support line is breaking away at 2, which historically could send a positive message to metals. The back your truck up level is to try to get the dollar to break below 93-ish, which this is where these lows would take place. So for the metals bulls to really get excited, maybe to take overweight positions, if it would break down here, that would be pretty good for metals, so it'd be something to watch for. This is a GDX, and talking about in a rock and a hard spot, multi-month pennant pattern, series of higher lows and lower highs. GDX and GDXJ had really nice days today, and one thing to expect this out of a compression pattern. These patterns, remember, they just frustrate the living heck out of bulls and bears. They're unless you're extremely nimble, this is just something to stay away from. But in time, this staying away and frustration can lead to really great moves because it has so many people off balance, just moving away from it. So if we'd see a metals breakout here, dollar weakness, franc strength, GDX stronger than GDXJ, those would all be positive messages that are bullish to the metals space. And some and all of that is happening and could continue. Sorry about that. So this is a look towards the end of today on the GDXJ GDX ratio. The GDX has been much weaker than GDX, even though GDX has been going backwards. GDXJ just found a way to go backwards a lot faster. And so this weakness, which has kept us, we traded in buying GDXJ here and got a really nice, rally and sold into strength as resistance. That's been the game, as if you can buy a bargain, you need to sell into strength in the metals. Someday that's going to change. Instead of selling resistance, you're going to buy support, and this could be one of those support points. We've been highlighting this, but here the ratio is at the bottom of falling channel A and also kissing this rising support line right here, that was last week, and then the gains that's predominantly influenced by today's action, with both GDX and GDXJ up strongly. Just GDXJ was up a lot more. You can see that there's an attempted breakout here. So I really like what I see as far as much potential and catching some people off guard after being pretty choppy for several weeks. This is one of my favorites that we've shared for a long time. It's nothing fancy, but it's the silver gold ratio, and going back into the 70s. And you can just see that if you just kind of step back and forget any of my red lines, that the bottom line is that this ratio is typically bottomed, down in this zone, and obviously peaked up in here. And then when it's had these falling channels and when it's broke out, it's tended to rally really sharply for quite a while, favoring a position of silver over gold. So we've continued to see weakness. You see this little curl here, which is potentially influenced just, obviously of late. This is a weekly chart, but if we'd see this breakout, it would be another, wow, we haven't seen that in a long time, because that'd be a 6-year breakout. So this not happening at this time, but that's something to continue to watch for, and if it does take place, a really bullish message if it does. Just a real quick couple of glances at the crude oil market. It's been dominated since 2015 by a series of weekly lower highs, and since 2016 a series of higher lows on a weekly basis, characterized by line 2. So essentially we have a pennant pattern of compression. The stock market has been able, for the most part, in the last few weeks, couple of months, to separate itself, not be quite as highly correlated to the stock space, from crude oil. They just haven't followed as precisely as what they once have at twists and turns. Bottom line is a breakout to the upside would be most likely a good growth story, and a very positive for crude during this time where crude is just kind of slightly chopped and went down some. Energy stocks have just really struggled. They've just been really weak and not a place to be part of this choppy action. And so in the past, if energy stocks have led crude lower, typically crude follows. So not a lot of bullish or bearish message. Right now, compression pattern continues to take place between 1 and 2. One of the things that I just can't get out of my head. This was the summer of 2014. For those that have been members since then, this is the Thomson Reuters commodity index. It looked to us to be one of the largest, if not the largest, head and shoulders topping pattern I'd ever come across, and commodities fell sharply. This came into this past year, a year and a half ago. So we saw this kind of counter trend reflationary rally. So far, the index has hit triple resistance here. It retraced 23%. This is the first time, remember, that commodities that went down 6 calendar years in a row. Didn't even happen during the Depression. So following that, then we see this rally coming back. Came up, so far has not even been able to do anything that I think is impressive at all, that it hasn't even been able to get above the 23% retracement level. So weakness here typically would reflect soft oil, soft commodities, and something that yields would typically fall in line with or be bullish for bonds. Just another look at, we looked at this earlier, but just another reminder of this is the same index, Thomson Reuters, that this is really a key resistance, and it's continued to fall since. But I just kind of wanted to show you why this is that 23% level that we looked at. So really an 800-pound gorilla for this commodity index remains in play. So we're going to look at positions that we have, and I'm going to go through charts on each of our holdings real quickly as a wrap up. So here's our positions 101 segment. So looking back, financials were the position that we've owned the longest. We addressed it earlier, so I won't spend a lot of time here. but we bought it right here at 1 last August. So we've had the position roughly 10 months, and we felt like some support was coming into play. And then we saw this blast off, and we sold into strength and just own 10% of the original shares, as we mentioned, earlier. My concern here would be for financials that this could be a head and shoulders top. If rising support and this neckline would break, two things would happen. I'd be stopped out of the remaining shares on this, and I'd look at shorting banks at that same time if that would take place. Not taken place. Head and shoulders top has not been proven, but it's something that just at this time looks like a potential topping pattern at a key resistance level. This is our second oldest position, being AGG, the bond fund. It was purchased here back last December after the sharp decline. We shorted bonds last summer, went long AGG. This was AGG is in my opinion, a more conservative bond play. If you were really going to be right on the direction of bonds and you were open to standard deviation, one of your first choices from an ETF world would be ZROZ. That was the stock bond ratio. It has a much higher standard deviation, or TLT. This was, I guess, my conservative way of trying to buy bonds without a lot of standard deviation. But regardless of any of that, you can see potential double bottom in AGG. It's pushed higher for the last few months. Looks like it broke above, came back down and tested this as support this past week, and it's pushing a little higher. AGG was experienced this huge meltdown that we talked about a couple times in prior slides. So a breakout here, as sharp as that was, has a chance to see, it's not necessarily a gap fill, but you can see a pretty good move to the upside in AGG due to this breakout. EFA, the European ETF, we felt like there was an ascending triangle forming here. Bought on the breakout at 1 several months ago, back in February. And we've seen a nice rise. We've sold into strength. We see some potential resistance at 2. The position right now is up about 12%. It's outpaced the S&P by a good, 8 or 9% during that same time period. But we sold into some strength, and I brought my stops up. I could see this potentially being a place where it chops sideways for a while because of just some of the prior resistance a couple of different times. So again, EF is still looking very good, just a big resistance test for it at hand. This would be Wal-mart. Bought Wal-mart back here right before this breakout. It broke above and then came back and tested what appears to be old resistance as new support. Dual here, and then it's blasted off. But you will see that Wal-mart is up against what appears to me as a couple of different key resistance tests. So I've sold into the strength. I believe Wal-mart's up probably 12% or more, but it's testing this dual resistance here. And from a long-term perspective, I don't think it's very clean, but I can't possibly not see what if this was a left shoulder, a head, and a right shoulder. Low odds, but something that we're watching closely. Regardless of any head and shoulders top, this is to me a key resistance price point. But Wal-mart's acted like a real champ as far as not telling any of you anything new, that retail's really stunk it up. Been very, very soft. You sure wouldn't have wanted to own XRT, the retail ETF. You wouldn't have any kind of the performance. So pat on the back to Wal-mart for whatever reason that's done it, but it's really bucked the retail trend and been a good holding for us. This is Apple. We applied Fibonacci to the 2015 highs and the 2016 lows. Bought Apple on a breakout, and it's treated as well. The 161 extension level of the move between the two ones comes into play at 162. So Apple's 155 has been a little higher here. It's going to chop sideways, but again, when it's trading again at 155 and a key level is 162, you know, we're what, 3% from what I think could be a key resistance level. But Apple continues to act healthy inside this very solid rising channel. This is Freeport McMoran. We were Freeport had a strong run up, hit some resistance, and then has fallen. Whoops, apologize. Fallen quite a bit. And this decline has taken it to its 38% fib level, and potentially at the apex of a bearish, or excuse me, a bullish falling wedge pattern. You know, this is just 2 days into the week. GDXJ was the stellar performer in the metals complex today, followed by GDX. But FCX had a good day on itself. I haven't seen the final numbers, but I think it was up around 4%, you know, on the day. So it did lag, like I said, GDX and GDXJ, but it had a real good move. And so some positive price action, you know, here. If we could see some further strength and a breakout, remember this pattern 2/3 of the time does lead to higher prices. This would be a great place to see a breakout, especially right at the 38% fib ratio. So I haven't had the position very long. Nothing good or bad has taken place, but today did like that positive action, and if it could continue, it would send a positive signal to FCX for sure. Just a reminder that we're in a new month. This is the June seasonal stocks that usually do well over the last 10 years in June. As a reminder, this has not been a month that the S&P over the last 10 years has bragged much about. You can see its median return was a negative 1.4% loss. Here are the top stocks. I'm looking at all of these patterns. We do own ILMN, but I do want to say this. It has nothing to do with us. This is just the computer sorts all S&P 500 stocks, looks at the month of June, and of all of the months when you lay them side by side, this is one of what I would call the weaker lists, because, you know, oftentimes some of the best stocks are in the 9 to 12% range here at the top, and some of those months that takes place, some of the worst performing are around, you know, like a 6% gain. So these are all positive numbers, but you can see just not really much to brag about. And I'm looking at all of these charts, and I have several alerts set of some things to take place, but this is not you know, when you talk about the dog days of summer, doesn't matter whether that's true or not, these are pretty doggy returns on average in the month of June, no matter how you cut it. So this is the Illumina position, as I just mentioned, that is historically strong in June. We bought it right down here on a potential support, had a good several days last week, and we saw some softness so far this week. We see that reflected in the red candle. It's a little bit off the low. So not a lot to brag about or be concerned about either way, but the 186, 187 level, this horizontal line was, you know, hit, as you can see, last October, and then it was hit again in April. If Illumina could break above here, you could see it gather some interest on the buyer side. Autozone, I did take a stab in a small position in Autozone and was stopped out today. I still find this stock really interesting. This is a quarter-century look at Autozone. It's obviously screamed higher, made this large rounding top, and has fallen off. Anytime you know, that I can see an intersection of a couple of support lines that are 15 to 20 years in length, it does interest me, and so this chart will remain on my radar. But this weakness that we saw today, I set a tight enough stop. I'm going to go back to the prior screen because I don't want much to do with below these two lines other than in a short position. So somewhat, because AZO had fallen off 20-25% in a short time, I essentially tried to catch a falling knife, you know, right in here, but I set a tight stop, and we were taken out today. So don't mind when that happens. I'll do it again and again on any stock that we can look at a 25-year potential support line I'll take a chance, on it. This is the Russell S&P ratio on a daily basis. You can see from 2016 to the start of this year, small caps were much stronger than big caps. So for about 6 months, they've continued to sell off, creating a series of lower highs and lower lows. The ratio actually hit the Fibonacci 50% retracement level of this 2016-2017 move here. Potential couple of other support points with momentum oversold. The reason I bring that up is, we just picked up small caps right here because of some of this weakness and this potential support. Here's the pattern on IWM that has the look of a traditional bullish ascending triangle. You can see a short-term series of higher lows and flat tops as just late in the week, small caps were making an attempt to push above. So I made a purchase here and then with a stop somewhere down in this range. But the measured move would suggest that on a breakout that small caps could add about 7%, based upon the size of the ascending triangle. So we'll just see. Small caps have lagged, but traditionally 2/3 of the time this leads to a breakout to an upside. So again, we've taken a small position in this with a fairly tight stop. So one of the stocks on the list for traditional June strong is a Dollar Tree. Now, like I said earlier, I don't consider this any kind of a big number, so I want to highlight this because it's not that impressive. If it was on some other month's list at the bottom, I might not bring it up even to you at all. But it traditionally has done, for the month of June, has done stronger than many of the other S&P 500 holdings. But kind of caught my eye was this potential support cluster, right down here in roughly the 76 zone today. I believe it traded or closed close to 76.80. So this could be a place for it to bounce, regardless of June seasonality. I wouldn't want to be long Dollar Tree below this potential support zone, but if we'd see a reversal or it start taking higher, the June seasonality might be favorable to this stock. So I'm not taking any position right now, but I really wanted to make you aware of this pattern in Dollar Tree. Another one I want to make you aware of, this is not on the June seasonal list, but it's a stock that I've been aware of for quite a few years. But this is a chart. If you look in the lower left, we're back into the 1990s. So we got a 20-year chart on a weekly basis that we're looking at, and AXDX has it made a peak here, as you can see, around 1997, made a lower high, and then just melted down from 30 bucks down to a whopping 28 cents. So I became aware of the stock up in here, and I'm just want to make you aware of this because it's knocked on this door several times, knocking on essentially the 30 door, and there's a chance this could be a bullish ascending triangle. And I'm not trying to profess anything about the fundamentals, the ownership, what they're trying to accomplish. I mean, it sounds interesting, but a lot of stocks sound interesting but don't work out. But I am very interested in this stock, that if it could take out the 30 level, it would be accomplishing something that it's tried to do many times over 20 years. And if it does break out, I could see this attracting buying pressure. So I want to just thank all of you for listening to this today, for your memberships. It's been a fun, several rewarding months for us, even though the market's up 2 or 3% over the last few months. As you know, some of our holdings were up 6, 7, 8, 10% more than that in the same time windows. So I appreciate you sharing your success stories and your membership and telling us, to your friends. We're really grateful and humbled, by that. So I wish all of you a great summer, great trading, and from Rick and I, thanks so much for your membership. All the best, everyone.